80% of construction companies fail within 20 years. Not because they can't do the work, because they can't fund the work. If that's you, or if you're about to bid on a project you can't afford to mobilize for, stop what you're doing. Because in the next 20 minutes, we're giving you the complete approval playbook that took us weeks of research to put together.
This isn't theory. We pulled this from lender documents, tax code, fleet benchmarks, and the actual mechanics of how construction loans get approved in 2026. By the end of this deep dive, you'll know exactly what you need, how to ask for it, and what to do if you get denied.
Right. And we are talking directly to you right now. Maybe you walked into your bank this morning, handed over your financials, and just got a flat no.
Yeah, it is a terrible feeling.
It really is. You have the skills, you have the crew, you even have the winning bid in your hand. But the traditional bank still turns you away.
Exactly.
Do not panic. We are going to unpack exactly why that happened and, how to fix it immediately. But first, we really need to talk about the absolute biggest killer of construction firms right now, the mobilization gap.
Oh man, that gap is just brutal. I mean, we are talking about the 60 to 90 days between the day you start a project and the day you receive your very first progress payment.
60 to 90 days.
Yeah, you are bleeding cash for 2 to 3 months before a single dollar comes back your way.
Let us make this real for a second. The mobilization gap is, well, it is like being asked to cater a 500-person wedding. But you have to buy all the Wagyu beef, rent all the tables, and pay all the waiters out of your own pocket.
Right.
2 full months before the bride and groom ever write you a check. It is insane. So let us break down what is actually draining your accounts during that window, because it is not just one thing.
No, it is a ton of things stacking up.
First, you have your surety bond premiums. Those take 1 to 3% of your total contract value right off the top, before you even break ground.
And then you have the yellow iron logistics.
Oh yeah, moving the heavy stuff.
Exactly. Moving heavy equipment is incredibly expensive. You are paying for flatbed transport, massive amounts of diesel fuel, and, local permits. And we haven't even touched on the labor mobilization yet.
Right, labor. Labor is a massive hurdle in 2026. Our research shows the construction industry is short about 349,000 workers right now.
That is a huge gap.
It is. And because of that shortage, wage growth is hitting 8 to 12% just to get guys to show up on the site. You have to pay them every Friday. But the GC isn't paying you for another 60 days. And then, then you hit the retainage trap.
The retainage trap is a massive cash killer. Project owners are withholding 5 to 10% of your total payment until the very end of the job to guarantee the work.
5 to 10% just held hostage.
Pretty much. And you can't count that money toward loan repayment.
Yeah.
You can't use it for short-term liquidity. It is essentially your profit margin, just locked in a vault for months, or even years sometimes.
Wow. So when you stack all those upfront costs against that retainage trap, you really start to see the picture. And add in the fact that construction material tariffs hit a 40-year high of 25 to 30% recently. All of this combined caused project abandonment to increase 88.2% year over year as of August 2025.
Right. 88% increase. So nearly double the number of projects getting walked away from. Who is doing the walking?
Usually the subcontractor who can't flip the cash, or, the contractor who took the job and realized mid-project they couldn't cover payroll. This is a cash flow problem disguised as a business failure.
That completely reframes the issue. I mean, it means the failure is not in the estimating or the craftsmanship.
Right.
The failure is entirely in the capital stack.
Right.
And that is exactly why finding the right capital partner is critical. If you are sitting there realizing your current bank doesn't understand the realities of construction cash flow, going to business loan, Directory is the first place you should look to bridge this specific gap. They categorize lenders who actually understand the mobilization phase.
Exactly. So if this gap is a literal death sentence for a contracting business, how are guys actually surviving it? Traditional banks might only offer you a generic term loan. But alternative and specialized lenders have tools built exactly for these 60 to 90-day voids.
Yeah, let us look at the 4 specific funding solutions available right now.
The first one is a mobilization loan.
Right. Mobilization loans are highly specific. They provide a lump sum of working capital based on your overall revenue history, not just the specific project.
Okay.
They are absolutely best for pre-award cash needs. When you know you need to buy materials and get a crew ready before the ink is even dry on the final contract, well, this is your tool. The lender is essentially betting on your past performance rather than your current empty wallet.
Makes sense. Then we have contract financing. But let me push back on this one for a second.
Sure.
If I am a contractor, right, and my personal credit got destroyed during the pandemic, why would a lender give me an advance on a contract I haven't even started yet?
Because with contract financing, the advance is actually based on the creditworthiness of the project owner or the general contractor you were working for.
Oh, interesting.
That is the genius of it. You use this when you have officially won the bid, but you haven't billed for any work yet. The lender looks at the massive, highly rated GC paying you, and they base the risk on their ability to pay, not yours.
That makes total sense. Okay, the third tool is invoice factoring. This gives you a 70 to 90% advance rate on unpaid invoices. But let me be very clear on the mechanism here. Factoring only works after you have billed.
Right, the invoice has to exist.
Exactly. You have done the work, you sent the invoice, and now you are waiting 60 days to get paid. You are essentially selling that invoice to a factoring company for immediate cash. But I have to ask, if I'm using a factoring company, doesn't that make me look desperate?
How do you mean?
Like, if my GC sees some third-party finance company collecting my bills, won't they assume I'm going out of business?
10 or 15 years ago, maybe. Today, absolutely not. It is completely normalized in the B2B space, especially with slow-paying clients. GCs know the cost of capital is high. They know you need liquidity to keep the job moving.
That is fair.
They would much rather see you use factoring to pay your guys on time than see the project stall because you ran out of cash.
That is reassuring. And finally, the fourth solution is a business line of credit. This is your revolving safety net for stretch projects. You get approved for a maximum amount, say $100,000, but you only pay interest on what you actually draw down.
Right.
It gives you incredible flexibility. If an excavator breaks down or materials jump in price, you just draw what you need.
Let me put you on the spot. What do you do if you're bidding Friday and you don't have the cash to mobilize Monday?
Good question. If you have strong bank statements but haven't billed yet, you want a mobilization loan or a line of credit. If you're waiting on invoices from a GC you trust, factoring. If you're buying equipment to do the job, equipment financing with deferred payments, so your first payment hits after the GC pays.
That deferred payment structure on equipment financing is a massive lifesaver. Lenders know you need the machinery working on site to generate the revenue to pay them back. It is a win for everybody.
Absolutely.
If you need to figure out which of those four products fits your specific situation, especially with a Friday bid deadline looming, use BusinessLoan.Directory to compare these four products side by side. It strips away the marketing fluff and shows you the actual mechanics of the offers.
Okay, so we've covered the products. Let's talk about who actually qualifies. Because I know contractors listening are thinking, my credit took a hit during COVID. Am I even in the game?
Before we get there, quick note. If this deep dive is giving you the clarity you've been missing, subscribe to this channel. We drop new construction funding deep dives every week. Leave a comment with your biggest funding question. We read every one.
Awesome. Let us break down the 2026 credit tiers from our research. We need you to know exactly where you stand before you fill out a single application. Applying to the wrong tier is a massive waste of time, and it puts unnecessary hard inquiries on your credit report.
Yeah, don't do that.
Let us start at the top with Tier 1.
Tier 1 is a 680 plus FICO score. This is traditional bank territory. It includes the SBA 7A and 504 loan programs. The advantage here is that you get the absolute lowest rates, typically sitting between 5 and 12% APR.
But the downside is the speed. Why are they so incredibly slow? We are talking 4 to 8 weeks for approval. If you need cash to mobilize by Monday, a Tier 1 bank is going to laugh you out of the lobby.
They are slow because they scrutinize every single detail of your financial life manually. They want zero risk.
Right.
That brings us to Tier 2. This is the 600 to 680 FICO range. We call this online term, loan and line of credit territory.
Okay.
Lenders like OnDeck, Blue Vine, and Balboa Capital live here. In Tier 2, speed is the name of the game. They can fund you in 24 to 72 hours.
How are they funding hundreds of thousands of dollars in 24 hours? You mentioned earlier that their underwriting is driven by open banking APIs. But, we are construction guys, not tech guys. What does that actually mean for the guy applying?
Think of an open banking API as giving the lender a secure pair of X-ray glasses directly into your business checking account.
Oh, I see.
Instead of waiting weeks for a human underwriter to manually read 3 years of your tax returns. Their algorithm looks at the actual velocity of money moving through your account this very morning. They see exactly what is coming in and what is going out in real time. Our data shows a 625 score in this tier can often get you access to $250,000 if your daily revenue velocity supports it.
That is incredible. 250 grand just based on cash flow visibility.
Yeah, it is huge.
Then we drop down to tier 3, which is the 500 and 1620 FICO range. This is actually the sweet spot for equipment financing. Why? Because the equipment itself acts as the collateral.
Right.
The lender feels secure because if you default, they just come take the excavator back. Brands like National Funding, Triton Capital, and ROK Financial's Marketplace absolutely dominate this space. They understand yellow iron, they know a used bulldozer holds its value, so they are entirely willing to overlook a lower personal credit score.
And finally, Tier 4. This is the 500 to 580 FICO range. And yes, you can still get funded here. Lenders like Fora Financial and various alternative revenue-based structures operate in this tier.
You will pay significantly higher rates in Tier 4, sometimes very high. But, if a fast alternative advance allows you to take on a highly profitable job that you otherwise would have to walk away from, it can absolutely make mathematical sense.
This is exactly why knowing your tier is non-negotiable. You do not want to go to a Tier 1 bank with a 590 credit score. You will get denied. And BusinessLoan.Directory allows you to filter lenders precisely by these FICO score tiers so you do not waste time applying to the wrong tier. It matches your reality to their exact requirements.
Exactly. So now that you know your tier, we are moving to the actual application. This is your approval playbook. And I want you to change your mindset about paperwork right now. Stop viewing it as a massive burden.
Yeah, totally.
Frame this paperwork as empowerment. We are going to break this down logically into 3 steps. Proving your past, proving your present, and proving your future. When you have this tight, you control the conversation with the underwriter.
Let us start with proving your past. These are the universal documents every single lender will ask for. You need 3 to 6 months of business bank statements. They want to see your daily balances and cash flow consistency.
Standard stuff.
Right. You need a government ID. You need 2 to 3 years of business tax returns. And this always catches people off guard. But you also need personal tax returns for every principal owner of the business.
Wait, why do they care about my personal tax returns if I'm applying for a business loan?
Do not fight them on the personal returns. Lenders want to see how you manage your personal finances because it directly reflects how you manage the business. If your personal finances are a mess, they assume your business finances will be next.
Okay, fair enough. Moving to proving your present. You need a current profit and loss statement. You also need a personal financial statement. Often this is SBA Form 413 or an equivalent document. But let us demystify that. What exactly is an SBA Form 413? That sounds like government alphabet soup.
It is actually very simple. It is essentially a basic snapshot of your personal net worth. It lists everything you own personally and everything you owe. It covers your house, your car, your credit card debt, and your savings accounts. Lenders just want to see if your personal financial house is in order before they give your business a massive check.
Got it. You also need a comprehensive debt schedule. You must list all of your current credit sources, long-term contracts, and any notes payable.
Let me emphasize this. The debt schedule is critical. Do not try to hide a merchant cash advance you took out 6 months ago. Their API algorithms will find it instantly, and hiding it is an automatic denial.
Do not play games with the algorithm. So those documents prove your past and present. But construction is a unique beast. Let us detail the industry-specific requirements you have to prepare to prove your future capability. First, you need your contractor license and all your bonding info. Sureties and lenders look very closely at your total bonding capacity.
Specifically, they calculate the ratio of your equity to your backlog. That ratio tells them if you have enough capital cushion to survive a project going sideways.
And that brings us to the absolute most important metric for construction lenders, accurate work in progress, or WIP. And backlog reporting is mandatory. Let us define backlog clearly. Backlog is your total signed contracts minus the revenue you have recognized to date.
Let me jump in on that. Exclude your verbal agreements, exclude your handshakes, exclude letters of intent. The bank only cares about firm signed contracts.
Absolutely. You calculate your revenue using the percentage of completion method. Think of your work in progress report like a progress bar on a massive file download.
I like that analogy.
Right. If you are doing a $100,000 job and your material and labor costs show you are exactly 50% done with the physical work, the bank needs to see that you have only claimed $50,000 of that revenue.
Right. And what happens if you tell them you have earned $80,000, even though you were only halfway done?
And the bank knows you are front-loading the job. You are eating into the project's future cash just to survive today. If your backlog ratio gets above 3 times your equity, lenders get very nervous. They think you are overextended and at high risk of project failure. Overstating your backlog can instantly kill your bonding capacity and your loan approval.
You also need additional project-specific documents. Have your contracts ready to show the lender? They prefer fixed price or cost plus contracts, ideally in standard AIA format.
What does that mean for the guys who don't know?
An AIA contract just means it uses the standardized forms created by the American Institute of Architects. Lenders trust them because the legal terms are universally understood.
Okay, good to know. And if you are doing heavy site prep or excavation, you need geotechnical reports no older than 5 years. Why do they care about dirt? Because soil data matters. If you hit underground rock or expansive clay and you did not account for it in your bid, your profit margins evaporate instantly.
Oh yeah, they vanish.
Lenders want to see that you did your homework. You also need to show proof of builder's risk insurance, typically for the contract amount plus 5%.
We need to bring up a massive 2026 hurdle that is catching a lot of contractors flat-footed right now. It is an accounting trap regarding your equipment. It is the new lease accounting standard, known as ASU number 2016-02.
Hey, explain this. This is the rule that fundamentally changed how leases are recorded, right? Before, you could keep operating leases off your balance sheet.
Not anymore. Now, nearly all leases must be reported directly on your balance sheet as a right-to-use asset and a corresponding lease liability.
So let me get this straight. If I lease a fleet of skid steers because I want to save cash and not buy them outright, that lease now sits directly on my balance sheet as a massive liability. Even though I am just renting them, that makes my balance sheet look significantly weaker overnight, completely by accident.
Exactly. And that accidental weakness directly messes up your loan covenants. It alters your debt-to-equity ratios. When an underwriter looks at your financials, they might see a highly leveraged company, even though your actual cash flow hasn't changed a single bit.
That is wild.
You really need to work with your CPA to ensure these lease liabilities are classified correctly, often as another liability rather than standard debt. This prevents technical defaults on your loans.
Wow. Having these exact documents ready, structured perfectly, and understanding how rules like the ASU lease standard impact your ratios, that is how you win the game. Having this full package prepped before visiting BusinessLoan.Directory guarantees the fastest possible approval time. You just upload the stack, and the matching process happens instantly.
And, getting denied by the bank today is not the end of the road. It just means you have to play a different angle. We call this the graduation strategy. Sometimes paying a higher APR with an alternative lender is simply the cost of inaction.
Think about the math here. Let us say you get offered a fast mobilization loan at 15% APR. Your gut reaction might be to reject it immediately because it is not a 5% traditional bank loan, but you have to look at the opportunity cost of walking away.
Exactly. If that 15% loan lets you secure a highly profitable job today, you take it. You use their money to execute the project. You capture that profit margin. But more importantly, you build the exact revenue track record and the completed project portfolio that traditional lenders want to see. You use the alternative lender to graduate to a 5% bank loan tomorrow.
It is a stepping stone. Stop feeling defeated by a bank denial. A no from a traditional bank is just a delayed yes if you pivot correctly. Gather your documents, organize your WIP schedule, figure out your credit tier, and start taking action on the alternative playbook we outlined today. You have the tools to fund the work. Now go build it.